I'm Alan Candle, a partner in Husch Blackwell's Employee Benefits and Executive Compensation Group. I counsel a wide variety of clients, publicly traded, privately held, tax-exempt, and governmental, as they navigate the highly regulated space of employee benefits and executive compensation. Welcome to our program today about benefit plans in the COVID-19 era. Before we begin, I would like to cover a few housekeeping items. At the bottom of your audience console, there are multiple application icons for your use during the program today. If you have any questions during the webcast, please submit them through the question box. We'll try to answer all questions during the webcast, but if a fuller answer is needed, or if we run out of time, we'll answer later by email. A PDF of the presentation is available in the resources folder. This program has been approved for legal education credit. To report your hours, click on the CEU icon at the bottom of the screen. A certificate of attendance, including course numbers, will be emailed to you tomorrow, along with a recording of the webcast for watching and sharing. Towards the end of the program, be sure to complete our short survey. We use your feedback to plan future programs that are applicable to your business needs. That's all for the housekeeping items. So let's get started with the program. Joining me today are Molly Hobbs, David Eckhart, and Gage Maurer. Molly focuses her practice on a variety of employee benefit and executive compensation matters. She advises clients on a wide range of employee benefits issues, including the design and implementation of qualified retirement plans, health and welfare plans, and equity compensation arrangements. David focuses his practice on employee benefits, executive comp, and taxation. He has extensive experience in executive compensation issues, including compliance of deferred compensation agreements under Internal Revenue Code Section 409A, and the structuring and tax treatment of equity arrangements. Gage works closely with individuals and businesses of all sizes, from startups to Fortune 500 companies, to plan and defend customized benefits and executive compensation plans. Gage also has experience with proactive audits, including Internal Revenue Service and Department of Labor compliance matters. To give you an overview of what we're going to cover today, we're going to start with a discussion, a relatively brief discussion of COVID-19 and other recent legislation. Gage is going to handle that. Then Dave and I are going to speak about retirement plan issues. Then Molly will speak about health and welfare benefit plan issues. And I'll wrap up if we have time. I'll address a couple of proposals that are in Congress currently. So, Gage, kick us off, please.
All right. So thank you, Alan. Once again, my name is Gage Maurer, and I am an associate here in Husch Blackwell's Employee Benefits and Executive Compensation Group. And today I am going to be going over some of the major pieces of legislation that passed during the COVID-19 pandemic. So first off here on the list is the Secure Act, which was actually passed right before the pandemic on December 20th, 2019. But a lot of the key provisions in the Secure Act will be taking effect soon, and David Eckhart and Alan Candle will be discussing those in more detail later in the presentation. Next on the list here, there is the FFCRA and the CARES Act, which are lumped together. They were both passed in March of 2020, and they were Congress's initial response to the pandemic. The CARES Act included several provisions related to qualified retirement plans, such as the 2020 waiver of RMDs. It also included the coronavirus-related distributions. So the CARES Act-related relief will be discussed in more detail later in the presentation. Another piece of legislation that Congress passed during the pandemic was the Consolidated Appropriations Act. in December 2020. And this act largely piggybacked off of the CARES Act by extending certain provisions like extending the employee retention credit, as well as extending favorable tax treatment for employer payments of employee student loans, for example. It also created temporary special rules for FSAs, such as allowing plans to extend their grace periods. So Molly will be providing some more background on that later in the presentation. Next, Congress passed the American Rescue Plan Act in March of 2021. And most notably, ARPA, as it's commonly referred to as, created a Cobra Subsidy. It imposed new COBRA notice requirements, and it also extended the employee retention credit until the end of 2021. And last on the list here, there were a few pieces of guidance relating to presidential emergencies and national disaster guidance, which we will be addressing as well. So first here is the employee retention credit. And the employee retention credit is a tax credit that eligible employers may claim against certain employment taxes equal to a percentage of the qualified wages they pay to their employees. So the credit is available for the period beginning March 12, 2020 and ending December 31st, 2021. And there are two key terms with the employee retention credit, and those are eligible employer and qualified wages. So if you understand these two terms, you will be able to determine who gets a credit and how much that credit will be. An employer may be an eligible employer in one of two different ways. First, the employer's trade or business could be fully or partially shut down because of governmental orders. And at the beginning of the pandemic, this was fairly simple and straightforward because a lot of non-essential businesses were forced to shut their doors. However, this became a little bit less clear as the mandates turned into guidance or recommendations. So recently, a more detailed facts and circumstances analysis is required to see if you're an eligible employer because of a governmental order. The second way you can be an eligible employer is through the significant decline in gross receipts test. And a significant decline in gross receipts was initially the period that an employer had a 50% decline in comparison to 2019. But beginning in 2021, this standard became more lenient, and it is now 20% of gross receipts decline in comparison to 2019. And the next term is qualified wages. So once you've determined if you're an eligible employer, you will need to determine the amount of qualified wages. And at its most basic, qualified wages are wages and compensation paid by an eligible employer. And those include certain health plan expenses. Importantly, the definition of qualified wages differs based on the size of an employer. So a small employer, it's easy. All wages paid during the period they are an eligible employer are qualified wages. However, for a large employer, qualified wages only include wages paid to employees during the period that they are not providing services. So the best example of this would be a large employer who furloughed employees during the pandemic and also paid them while they were on furlough. So on this next slide here.
Hey, Gage,
yeah.
Can you hear me? We got a quick question here already on this, going back to eligible employers. And I know you and I have kind of been looking at this for different clients, and we have companies that are asking whether or not they're an eligible employer. And it's kind of challenging, actually. You have to go back and look at the actual government orders, right? And kind of make that determination and analysis. But the question we got was, is there any minimum period of time for which the business must have been suspended or suffered a significant decline in gross receipts? And the gross receipts test, correct me if I'm wrong, but it measures from currently, and looking back over the past year, basically you take two kind of snapshots in time, I believe. And then as far as the eligible employer goes, I don't know that there's any minimum period of time for which the business must have been suspended, but they'd only be an eligible employer during the period of suspension.
That is my understanding.
Right. So, and that is how we are, helping some businesses when they're coming to us and saying, hey, how, are we eligible or not? And we help them kind of go through that analysis and talk through the risks and rewards of taking the credit or not taking the credit.
So on this slide here, it shows some of the major changes that have happened to the employee retention credit as new legislation has been passed. One of the key ones is that second bullet point. At the beginning of the pandemic in 2020, the credit was limited to 50% of qualified wages paid in all of 2020, so a maximum of $5,000 per employee. And then with the passage of the CAA and ARPA, that was increased to 70% of qualified wages paid each quarter. So $7,000 maximum each quarter per employee. I discussed large employers on the last slide, and large employers were at the beginning of the pandemic 100 or more, and now they are 500 or more starting in 2021. So on this next slide, we have a quick poll. The question is, did your company claim the employee retention credit? So give everybody a few seconds to answer that.
And Gage, you want to just quickly touch on the 941X?
Yes. Yep. So as you can see here, if you did not claim the credit, but you think that you may be eligible to claim the credit, you still have an opportunity to do so. And you can do that by filing a Form 941X. All right, so we'll see those results. So it looks like most people have not claimed the employee retention credit. So if you do think you might qualify, it might be worth amending one of those Forms 941. So the next topic is the outbreak period extensions. So around the time that the COVID-19 pandemic began, the DOL and the IRS decided that the pandemic could cause some disruptions for both the plan participants and the plan sponsors. And for that reason, the DOL and the IRS issued joint guidance extending certain deadlines related to retirement, health, and welfare plans. These extensions they're pretty similar to other extensions adopted by the departments and other disasters like hurricanes, but the COVID-19 extensions have been for a much larger national scale and have been for a much longer period. So at its most simple, the outbreak period began on March 1st, 2020, and it ends 60 days after the national emergency. But where it gets a little confusing is that the DOL and the IRS are required by statute to limit their extensions to 1 year. What that means here is that the maximum outbreak period is 1 year from the date a particular individual or plan was first eligible for relief. So on the next slide, I go through some of the examples of what was extended. So most notably, a lot of these extensions relate to COBRA. And for example, during the outbreak period, the deadline to pay COBRA premiums is extended, and there are no deadlines for employees who lose coverage to notify the plan. As a result, employers may have to provide COBRA coverage retroactive for many months, and this could result in adverse selection if individuals wait to see if they incur claims before they actually elect COBRA. Also, the HIPAA special enrollment period is also extended, and there is no special enrollment deadline during the outbreak period. When read together, though, with the 1-year requirement, this generally means that an employee has 1 year from the date of marriage, for example, to actually exercise their special enrollment rights. So lastly, adding to the confusion of the outbreak period.
Gage, excuse me,
yeah.
Let me interrupt a second. We have a question asking if we have any idea when the national emergency will end for purposes of these extensions. And I don't know about you, but I have no idea when they'll cease. You know, we have the Delta variant now. I don't know what's coming next.
Mm-hmm. I agree. I have not seen any indication that it'll end anytime soon. One point on this slide, in a separate order, in the HHS's emergency order, they have let the state governors know in a letter that when they do want to end the emergency, they're going to give them, I think it's 60 days notice. So I would imagine that they would do the same thing with the outbreak period, but we shall see. But what's confusing here is that we have the outbreak period, but we also have this completely separate public health emergency that was declared by HHS. And the HHS's emergency declaration expires automatically every 90 days unless the secretary issues an extension. And so far, HHS has been issuing extensions on a regular basis since the beginning of the pandemic. The last declaration extended the emergency through October 18th, 2021. And like I said, a letter from HHS went out to the state governors just to let them know that they're going to give them a heads up that they will be not renewing it, but also they let them know that they plan to have it extend at least through 2021. And what HHS's public health emergency relates to is it triggers the requirement for group health plans and issuers to provide coverage for COVID-19 testing and related services, and those are under the FFCRA and the CARES Act. So I will turn it over to David Eckhart and Alan Candle now.
Real quick though, on these suspension notices, I mean, I think what we're finding is, you know, it's helpful for employees, right? Where they're going to have a lot more time to make elections and apply for COBRA and so forth. But for employers, particularly those with self-insured plans, it kind of extends their exposure to these claims for, you know, a long period. And so that's kind of been the challenge for employers, particularly with self-insured health plans.
Very true.
Okay, so I should have warned you at the beginning that we have a lot of material to cover in this hour that I'm hoping we'll be able to fit all this in. So I'm going to take the next couple of topics that both relate to retirement plans. The first one is plan restatements. This applies to qualified defined contribution plans, and particularly the pre-approved plan cycle. Of course, this is outside of all of the statutory changes that Gage was mentioning, but IRS procedures provide a way for qualified retirement plans to be updated periodically for changes in the law. Pre-approved plans are on a 6-year cycle for restatements, and now we are in a 2-year window for restating pre-approved defined contribution plans this is the third restatement cycle for pre-approved defined contribution plans. The plans that are eligible for this are plans that already are pre-approved documents, which means that they are documented on a prototype plan, what used to be called the volume submitter plan. These are all, plans that the providers of those documents submit to the IRS, get IRS approval for, and some of them can be changed from what the IRS approved, and you can get a determination letter on the plan as changed. But again, we're right now in the middle of a period for restating pre-approved plans. That period ends July 31st, 2022. The restatement process takes some time, whether it's on a kind of traditional prototype plan or a plan that is a unified document, as opposed to a prototype with an adoption agreement and a basic plan document. For either one of those, the restatement process takes some time. And so this is something that if you haven't started the process yet, you should consider speaking with your provider about that. I had mentioned that it applies to individually designed plans that switch to being pre-approved. There are a number of reasons that a plan that currently is individually designed may want to switch to a pre-approved type of format. The IRS used to have a 5-year cycle for individually designed plans to be restated and to receive determination letters. And of course, the purpose for the restatements and determination letters is that the plan, at least the form of the plan, will be qualified. That could be important for audits if the plan is large enough to require audits by a CPA annually for the 5,500. It could be something that's important in transactions that the employer engages in, because typically you have to make representations about the plan documents, the employee benefit plans that an employer has. So as well as the possibility of an IRS examination of a plan or a DOL examination, a plan really does need to remain current, and having the approval of the IRS, it can be important for all these reasons. The 5-year cycle has been eliminated for individually designed plans. So, individually designed plans now may want to switch over to becoming stated on a pre-approved plan document. As part of the elimination of the 5-year cycle, determination letters can only be requested for individually designed plans now at the initial adoption of the plan and at termination, as well as if a plan is involved in a merger due to a corporate transaction. So, outside of initial adoption and termination, generally an individually designed plan will not be able to get a determination letter. And so that could be a reason to switch over to a pre-approved plan. Some plans that had always been individually designed before, such as employee stock ownership plans, now are able to be stated on written on a pre-approved plan document, whereas that was not possible before. I had mentioned that it may be possible to get a determination letter for a modified pre-approved plan document. That's if the modifications are not extensive. We have seen so far in the process that the IRS has not treated changes that we have made for our clients for the pre-approved plan documents that we have to be extensive. If they are considered extensive, then you're kicked out of the pre-approved program. You're considered an individually designed plan. And there's always some nervousness, how many changes will make the IRS kick a plan out of the pre-approved plan process. We don't have a good answer to that, but we haven't seen that. Haven't seen the IRS be overbearing on that point. Another recent development has to do with plan corrections. The IRS issued this past July a new revenue procedure for plan corrections. Qualified retirement plans are complicated. Mistakes happen all the time. And the IRS has a 140-page procedure that describes different kinds of failures for plans, whether they're operational failures, plan document failures, or other kinds of failures. It has safe harbor corrections. It sets out 3 basic categories of corrections: self-correction, what's called VCP or Voluntary Correction Program with IRS approval, and if all else fails, there's audit cap, which is the most expensive of these 3 alternatives. In the recent RevProc, one of the changes was to expand self-correction. The rule had been that if a significant operational failure was to be corrected by self-correction, or a document failure that could be self-corrected, if those had to be made within 2 years after the end of the plan year in which the failure first occurred. That now has been expanded to 3 years. So that gives a little more time for plan sponsors to discover any failures and as well as to correct the failures. Another change that was made by the recent procedure is to anonymous submissions. Previously, a plan sponsor could submit under the VCP program on an anonymous basis. And in the VCP program, what you do is submit an application with a full description of the failure and a proposed correction. And if the proposed correction is a safe harbor correction or one that you have a high degree of confidence that the IRS will accept, then there's no reason to submit anonymously. On the other hand, if the sponsor wants to propose a correction that's a little bit out of the ordinary, it's not a safe harbor correction, and you're not sure if the IRS will accept it, then the anonymous submission is a way to get IRS approval without identifying the plan or the plan sponsor. And then once the approval is once the correction is agreed upon, then full disclosure is made and the IRS will issue a compliance letter. Can't do that anymore. Instead, plans can apply for a pre-submission conference on an anonymous basis. And a similar process will occur with the pre-submission conference. There has to be disclosure of the failure, proposed correction. There's a meeting with the IRS to discuss it. However, any comments made by the IRS in the pre-submission conference are not binding. So it's not. So if you have a pre-submission conference and there's agreement on a proposed correction, there is going to be some uncertainty about whether the IRS will actually accept the correction that was discussed in the conference. And so there may be a little bit more risk under the current procedure than there had been in the past. But again, that's a change that we have. A third change in the correction procedures is in connection with recouping overpayments from a plan. If payments are under a threshold amount, then the employer doesn't have to try to get them back. That threshold has been increased from $100 to $250. So now we have our next poll question. And the question is, how has your organization corrected plan failures? By self-correction, VCP, which is voluntary submission to the IRS, audit cap, other, or no correction needed. And you can check any of them that apply.
And Alan, you know, how this is relevant, I think, is we usually get questions from clients when their auditors are looking, you know, at their plan and they're doing audits, right? And so, you know, this comes up a lot when they're auditing the plan. They're saying, hey, how do we correct this? This is going to give clients a little bit more opportunity to self-correct. Is kind of how, you know, and it's definitely beneficial. So
that's right.
That's right. You know, as you're going through those audits and you're cleaning up the plan, this should be helpful.
Yeah, it should be. I mean, self-correction is better in some ways than VCP because you don't have to apply to the IRS. You just do it. And if the correction is consistent with the safe harbor correction, or with, if not a safe harbor, at least with the correction principles that are set out in the procedure, then that's a good correction. With VCP, you have to submit it to the IRS. It's a little more formal. At the end, and there's a fee, maximum $3,500 fee. At the end of the day, with VCP, you get a compliance letter, which is IRS approval of the proposed correction, which you don't get in self-correction. Yeah. So it looks like about 40% of you who have replied, at least, have done self-correction. About 24% have done VCP. We don't have anybody who's done audit cap, which is good because that's a very unpleasant process. And then there are other corrections, and a little more than half say no correction is needed. So that's great. So I'm going to turn it over to Dave now. Okay.
Thanks, Alan. Oh, I got to go back a slide. So I'll talk about some of the actual changes here that are being made to retirement plans and how that's, you know, when all these changes have to be made. And how this relates to the restatement process is, you know, we are getting a lot of clients that have new restated documents. And so what we have to do is make sure that all of these plan changes are included in the document if the company wants to include them. So the first change I'm going to talk about are hardship withdrawals. And just as a quick background, 401k plans are permitted but not required to offer hardship withdrawals. And there's really two main considerations. One, the participant needs an immediate and heavy financial need, and the distribution must satisfy that financial need, meaning they don't have any other resources to pay for it. So they need to take a distribution from the 401k plan. And the plan must establish objective standards on how to determine whether a hardship is, whether the participant is eligible to take a hardship. So recently the IRS issued guidance, and there were some law changes that expanded the availability of hardship withdrawals. So the types and the sources of funds in a 401k plan have been extended, and there are more sources available now for hardship withdrawals. There's been a pretty big expansion of the safe harbor events. And so if you go through these lists, these are the different events that qualify to receive a hardship distribution, and the bolded and underlined portions of these events are the new additions. So for medical expenses, this was prior, it was only available to participants and the participant's spouse, but now it can also include a participant's primary beneficiary. Costs directly related to the purchase of a principal residence, the payment of tuition or educational fees, room and board, etc. This also now includes the participant's primary beneficiary under the plan. Payments necessary to prevent the eviction of the participant from their principal residence or the foreclosure on the mortgage. Payments for burial or funeral expenses for the employee's deceased parent, spouse, child, dependent, or now the primary beneficiary under the plan. Expenses for the repair of damage to the principal residence. And this is now without regard to whether the loss is attributable to a federally declared disaster. So it doesn't have to be a declared disaster. Expenses and losses incurred by the employee on account of a disaster that's declared under this law. So a couple of changes there that should expand, the availability of these hardship withdrawals. I think more importantly, other than just the safe harbor events, the regulations now have removed the 6-month suspension of elective deferrals. So in the past, if somebody took a hardship withdrawal, they could not make elective deferrals for 6 months, which then, potentially they were losing out on a match. So the regulations now say if you take a hardship withdrawal, you don't have to suspend the elective deferrals for 6 months. There's also no requirement to take a loan first. In the past, there was a requirement to take a loan from the plan first, and then once the loan was exhausted, then they could take a hardship withdrawal, but that's no longer a requirement. However, a plan by choice can require a loan to be taken first. A participant must obtain other available resources first. They must certify to that. And they must represent that they lack other resources. And so this is kind of always an issue because, the question is how do you know that the participant lacks other resources? And now there's a certification that the employee can make, and it even can be verbally on a recorded line or through email or some other method. And as long as the administrator doesn't have any contrary knowledge that they lack other resources or that they have other resources, then the plan can rely on that certification by the employee. So that's kind of protects the company a bit. These new rules apply to withdrawals after 1/1/2020. The deadline to adopt is December 31st, 2021. So what we've been helping clients with is looking at these amendments, making sure they line up with what the company has done over the last year and a half, and making sure the documents line up with that. It also is kind of interesting because this amendment deadline is due at the end of this year, but the restatements, some of them will not be done until next year. So if we don't have a restated document yet by the end of this year, then we need to make sure that the plan is amended to include these hardship withdrawal changes. And then, also how we get involved just on the practical side of things. A lot of times companies will outsource this service to determine hardship withdrawals. And, if there's a question about whether somebody's eligible, or there's a question about the documentation that's needed, or maybe the company wants to kind of override the service provider in determining, whether someone is eligible to receive a hardship, that's kind of, how we get involved in this area. So quick poll question. Has your plan been amended for hardship withdrawal rules? Yes or no, or I don't know. So just in the interest of time, we'll see what the results are here. Let's see, we only got a few submitted yet. Here we go. So far, about almost half say yes, that's great. About a third say no, and 25% say no, or that they don't know. So that would probably be a good thing to check up on before the end of the year, because those plan amendments are required. So I'll kind of go through some other amendments that are required here under the Secure Act. If your plan has a automatic enrollment and escalation feature, there was a 10% limit on how much you could auto enroll someone at. Now that's increased to 15% after the first year of participation. So that's supposed to encourage a higher percentage of deferrals. If your plan is a non-elective safe harbor plan, there's no safe harbor notice that's required. If your plan allows loans through the use of credit cards, which I really, to be honest, haven't seen any of those, you can't use credit cards for loans any longer. Probably not a huge change for many companies. Portability of lifetime income investments. If your plan offered a lifetime income investment like an annuity and you decide to take that away, the participant now has an option to roll that over into another plan or an IRA. Long-term part-time employees. This will be a big change, I think. It actually doesn't go into effect until 2024, but the gist of it is that if you have an employee that works at least 500 hours a year in 3 consecutive years, they will be eligible by law to participate in the plan. And so what companies have to start doing now is start tracking those hours for those part-time employees, because even though they're not hitting the 1,000-hour requirement that would otherwise make them eligible, we still got to track them over a 3-year period to see if they'll be eligible in 2024 and beyond. So this is nothing that has to necessarily be in the document yet, but companies do need to kind of change their administrative practice to track these employees to see if they're going to be eligible in 2024. Qualified birth or adoption distributions starting in 2020. So now there's a $5,000 penalty-free distribution upon birth or adoption of a child. There's an increased beginning date to age 72. So before for required minimum distributions, once somebody turned 70 and a half, the plan had to start distributing out RMDs. That has now changed to age 72. So it allows employees to stay in the plan a little bit longer before distributions have to be made. And where this is important, I think, is depending on your document. We have some documents that reference specifically age 70 and a half. That's going to require an amendment to your plan. Conversely, if it just references the rules, well, by default, the rule has changed. So then you just have to change it administratively, not through an amendment. RMDs for a beneficiary. So the rule has changed now where if a participant dies, generally speaking, the remainder of the account has to be distributed out by 10 years after the year of the participant's death. There is an exception, though, for a surviving spouse or a beneficiary who's disabled or ill, chronically ill. If they're not more than 10 years younger than the employee, or if there's a child under the age of majority. So for those types of beneficiaries, the distributions can span longer than 10 years. But if it's not one of those beneficiaries, then the plan has to distribute by the 10th year. In-service distributions for pension plans has been reduced from age 62 to 59 and a half. And then, so for the amendments for the Secure Act for all of these, and these aren't necessarily every single amendment, but it's these are the most common issues that we're seeing. The last day of the plan year that begins in 2022 is the deadline to amend. So when it starts next year, the plan year that starts next year, we have to amend by the end of that year. CARES Act, we had a RMD waiver for 2020. So any RMDs that have been issued in 2020 can be rolled back into the plan. Coronavirus-related distributions, this is optional. We did have a lot of clients that did this. So if you did allow this, then the plan needs to be amended. And these were for distributions that were available during 2020. Basically, it's a distribution on account of a COVID-related reason, which I'll get into in a second. But if someone takes this distribution, they would incur taxable income over 3 years if they want to keep the money, or they can roll it back into the plan over 3 years as well. The total can't exceed $100,000, and it's not subject to the 10% penalty. Coronavirus-related loans, again, this is an optional provision, so if you allowed it in your plan, then the plan needs to be amended to provide for it. But basically, you can now take a loan up to 100% of the balance and up to $100,000, which is an increase from what it used to be. Suspension of loan repayments. So if anybody had their loan repayment due between March 27th, 2020 and December 31st, 2020, there's a suspension of the loan for up to a year. Who is a qualified individual? The IRS gave some guidance. anyone who's diagnosed with COVID, any spouse or dependent that's diagnosed with COVID, any participant or spouse that experiences an adverse financial consequence due to the virus, being quarantined, being laid off, having a reduced pay, being unable to work because of childcare issues. So the IRS, there was a question about whether the spouse or somebody in their household, if they incurred one of these situations, whether the participant could take a coronavirus related distribution, and the IRS said yes, they can. So again, key point here is that if your plan has made these changes based on the Secure Act or the CARES Act, amendments aren't due until the end of 2022 plan year, but make sure that you keep track of which of these options your plan has implemented. And with that, Alan, I think I'll turn it over to you for lifetime income illustrations. I know we don't really have too much time, so this isn't a huge change, but I'll let you cover that.
Thank you, Dave. Yeah, I don't really want to spend a lot of time on the lifetime income illustrations other than to say that this is a new requirement. It applies to all defined contribution plans. ERISA requires all plans to provide participant statements, annual participant statements for participants who cannot elect that cannot direct the investment of their account balances, and quarterly statements for participants in defined contributions that can direct the investment of their account balances. The Secure Act added the requirement for an annual disclosure of the lifetime income stream equivalent of the total benefits accrued. Regulations go into detail about what is it that needs to be disclosed, the interest rate, mortality assumptions that are used for the disclosure. This is first effective next year. The Department of Labor came out with FAQs a couple of months ago, saying that for plans that provide for participant self-direction, the latest time that the first lifetime income illustration can be provided is for the statements for the second quarter of 2020. And for plans without participant self-direction, it's statements for the first plan year ending after September 21, 2021, which in the case of a calendar year plan means that the first statement that it'll apply to is for the calendar year 2021 participant statements. The only comment I would make on this is that the requirement to provide the lifetime income illustrations applies without regard to the form of benefits that are provided under the plan. In other words, if a plan provides for a lump sum, you have to provide lifetime income illustrations. If a plan provides for alternative of lump sum, annuity, installments, have to provide lifetime income illustrations. If, as in the case with ESOPs, a plan commonly will provide for 5 annual installments, you still have to provide the lifetime income illustration. So I expect it'll be a little confusing for some participants, but that is that's the law, and it will have to be complied with beginning next year. So now let's hear from Molly.
All right, my name is Molly Hobbs, Senior Associate in our Denver office, and I am going to talk to you all a little bit about health and welfare plans. Because I was slated to speak last, I have elected to sprinkle emojis throughout my slides, so hopefully you will all re-engage and be as excited as I am about said emojis. So I'm going to talk about 6 things. We are a little tight on time, so I will try to be brief, but hopefully helpful. So I'm going to talk about COVID-19 relief plan amendments, mental health parity, healthcare transparency, surprise billing, and quickly touch on Cobra Subsidies and vaccine incentive programs. So first up, obviously over the past year and a half, as we've all alluded to, we've gotten quite a bit of COVID-19 relief. Within the health and welfare space, some of these things happened automatically. As Gage mentioned, during the outbreak period, we had some extensions and those happened automatically. There was an expansion of the definition of qualified health expenses for FSAs. That was also automatic. However, there was quite a bit of relief that had optional provisions. So I am going to walk through all of the optional plan provisions that we have had over about the past year and a half, hopefully to jog your memory. So if any of this is starting to sound familiar, like maybe you've implemented it within your health plans or your FSA or your DCAP, it is very possible that you need to amend your plan. So chronologically, starting in May 2020, we got some IRS guidance in the form of 2 IRS notices. Those did 3 things. So first off, they allowed mid-year election changes for health plans, FSAs, and DCAPs, which essentially allowed an individual enrolled in any of those to prospectively make an elective change or revoke a election absent a change in status event. The second thing that happened was that they extended some claims periods for FSAs and DCAPs. The last thing was an increased carryover limit for FSAs. They bumped the carryover limit to $550. Later that year, in December 2020, under the Consolidated Appropriations Act, or the CAA, which I'm going to talk quite a bit about in just a bit here, there were some changes hidden in there as well. The first one was to allow the same mid-year election changes that I just mentioned for health plans, FSAs, and DCAPs to allow those in the 2021 plan year. The other thing was an unlimited carryover for FSAs and DCAPs. So obviously for FSAs, that the 550 carryover limit became kind of null and void if you adopted this unlimited carryover. This one was interesting as well because, as you may know, carryovers are generally not allowed for DCAPs. We also got a grace period extension for FSAs and DCAPs, some additional spin down provisions for individuals who ceased participating in an FSA mid-plan year, where they would be allowed to continue to incur expenses and spend down their account for the remainder of the plan year. And the last bit of guidance in the CAA was the maximum age for DCAPs went to age 14. So normally with DCAPs, if you get a child that turns age 13 and under, but under the CAA relief, you essentially got an extra year. Last but not least, in this more recently in March of 2020, we got the American Rescue Plan Act, or ARPA, and this increased the maximum contribution for DCAPs. So if you are married filing jointly, it went from $5,000 to $10,500. Married filing separately went from $2,500 to $5,250. So if any of this is sounding familiar, like maybe you implemented it within your health plan or FSA or DCAP within the past year or a half, you probably need to amend your plan. When do you amend? If your change was effective in 2020, you need to adopt an amendment no later than December 31st, 2021. So that is in just a couple months. If your change was first effective in 2021, you need to adopt an amendment no later than December 31st, 2022. All right, I've got a poll. So have you implemented any of the optional COVID-19 relief? I'll give like 30 seconds for you all to jump on board and tell me that, whether you have implemented or not. And then we can keep moving. And all right, so we have got some results here. I'm going to keep cruising since we are tight on time. So apologies if we didn't get to you, but there is our spread. So it looks like at least the majority of you have jumped in on some of the optional relief. Okay, so as I mentioned earlier, we had the CAA come out, and the CAA did, in addition to the optional relief that I just mentioned, there were kind of 3 additional important things that were buried in there, all of which I think we could spend at least an hour talking about. Fortunately for all of you, I am not going to do that, but I am going to mention them all at a very high level. So we have mental health parity, healthcare transparency, and surprise billing. So the first on our list is mental health parity. Mental health parity is not new. The general premise is that if your health plan provides for mental health and substance abuse disorder benefits, that your plan has to treat those benefits equal to medical and surgical benefits. So none of this is new. What is new is that the CAA came in and said that if your plan provides these benefits, that you must conduct a comparative analysis for the non-quantitative treatment limitations. And those include prior authorization requirements, concurrent review, standards for provider admissions to participate in a network, and out-of-network reimbursement rates, among other things. Basically, the big takeaway here is that you do need to prepare some sort of comparative analysis for your non-quantitative treatment limitations. The bad news, maybe good news, is that we have no idea what format this is supposed to be in right now. So we have really, really limited guidance on the format. At the very least, we recommend that you start working with your vendors, your providers, your attorneys, your consultants to at least put some thought into this analysis and start preparing something. So there is some guidance out there in terms of where you can start. But at the very least, you need to start asking questions and start thinking about it. Cost transparency, as background, this kind of spreads administrations. This was started by the Trump administration, picked up in the CAA. Essentially, health plans are going to need to provide price comparison tools, ID cards showing cost sharing, some advanced EOBs. There's a bunch of stuff living in there, but we very recently, I think as recently as yesterday, actually just got the notification that the regulators are going to push a lot of these deadlines. So this is on the horizon, but probably not as on the horizon as it initially was. A note on surprise billing. So the CAA imposed the No Surprises Act, which is essentially a prohibition on balance billing in some very specific circumstances, including emergency services, ambulatory services, and services provided by a non-network provider at an in-network facility. For health plans, probably the biggest thing you need to put on your notes here is that it's going to shift cost sharing. So there's going to be a 30-day timeline to send initial payment or denial notifications to certain providers, and that there is an independent dispute resolution process. All right, approximately 30 seconds for my 2 remaining slides here. So Cobra Subsidies under ARPA, these are actually officially dead as of yesterday. The reason I wanted to mention it is because under ARPA and these new subsidies provisions, there were some new notice requirements. If you did not abide by the notice requirements, you can get into trouble. So there's still, those notices are treated the same as other COBRA notices. So if you don't provide them, or if you provide them late, you could get into some excise tax issues. So make sure that you have done the notices with respect to the new COBRA subsidies. And the last one is vaccine incentive programs. That can affect your health plan, your HIPAA, ADA, ACA affordability analysis. At this point, based off of what I'm hearing from our labor and employment colleagues who did an excellent webinar, I think last week, on vaccine incentives and mandates, is that we have really moved beyond the carrot in terms of trying to incentivize folks, and that most employers that are still thinking about this are starting to contemplate employer mandates. So we've moved from the carrot to the stick. So, but to the extent you are contemplating a vaccine incentive program, there are some implications if you're considering incorporating your wellness program or your health plan. With that, I think we're back to Alan for a quick look to the future and closing comments.
Thank you, Molly. Love those emojis. There are a couple of proposals in the $3.5 trillion social policy package that the House Democrats are trying to get enacted. While that package may not be enacted, some of the changes in the retirement plan space may, I think, be on the agenda for the foreseeable future. One of these is a prohibition of what are called backdoor Roth conversions, or generally the ability of either IRA holders or qualified plan participants to convert their regular accounts to Roth accounts. And then another proposal is to have minimum distributions for high-income taxpayers that have mega accounts in IRAs, qualified plans, or both, with all that being combined. A mega account being an account that has a balance of greater than $10 million. So I'm not going to spend any more time on that because we are out of time. I would like to thank everybody for joining us today, and we hope the information was helpful to you. As a reminder, the program has been approved for legal education credit, and to report your hours, click on the CEU icon at the bottom of the screen. A certificate of attendance, including course numbers, will be emailed to you tomorrow. And please be sure to complete our short survey. We use your feedback to plan future programs that are applicable to your business needs. This concludes our webinar. Thank you.
And real quick, Alan, I did see there were some questions. So if you left us a question and we didn't get to it, we will follow up. So thank you.
Yeah, thank you, Dave.